Hey there. If you've ever wondered how to actually get those stock dividends you hear about, like understanding the origin of these funds and how they make their way into your account, well, you've landed at the perfect spot. Today, we're going to unravel this process, guiding you through each stage. Let's dive in. First off, what are dividends? Think of them like a thank you check from a company you own stock in. When a company makes a profit, they might share a slice of that cash with shareholders, aka you. Not all companies do this though. It's usually the bigger, stable ones, like Coca-Cola or Johnson & Johnson. Find good dividend-paying stocks. You can use stock screeners on websites like Yahoo Finance, Finviz, or directly through your brokerage platform. When you're looking at stocks, pay attention to the dividend yield metric. That's the percentage return you'll get based on the stock's current price. Most solid dividend stocks fall somewhere between 2 and 6%. You'll also want to check the company's dividend history to find consistent payers. There's actually a special group called dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. That's a pretty impressive commitment to shareholders, right? Once you've picked a stock, you need to own it before the ex-dividend date. That's the cutoff to qualify for the next payout. Buy the stock through your brokerage account, Robinhood, Fidelity, or whatever you use, and hold it before that date. If you miss it, no dividend for you this round. Timing matters. Here's how the timeline works. The declaration date is the date that the company declares there will be a dividend. At this time, they will disclose the dates and terms of the dividend. The ex-dividend date for shares is typically determined as the record date or the business day preceding it. If you acquire shares on or post its ex-dividend date, you won't be eligible for the forthcoming dividend payout. Instead, the seller gets the dividend. The record date is the date shareholders who own shares as of this date will receive the dividend. The difference between the record date and ex-dividend date is the ex-dividend date is usually 1 business day before the record date. This is because stock trades typically take 2 business days to settle. So if you buy a stock one day before its ex-dividend date, your trade will not settle until after the record date, hence you won't receive the dividend. Finally, there is the payment date, the day the payment is made to shareholders. When it's time to pay out dividends, the company sends the total dividend amount to this transfer agent. The agent's job? They maintain the official list of shareholders and calculate exactly how much each investor should receive based on their share ownership. If you hold your shares directly through the transfer agent, companies like Colonial stock transfer, you'll get your dividend payments straight from them. But here's what most investors experience. If you hold shares through a brokerage account, the transfer agent sends the dividend money in one lump sum to your brokerage firm. Your broker then immediately credits your personal account with your exact portion. No action required on your part. The magic here? Whether you receive dividends directly or through your broker, the entire process is completely automatic on your end. The money simply appears in your account on the payment date, like clockwork. The whole system is designed to work smoothly behind the scenes so you can focus on growing your investments. Most companies pay dividends quarterly, but some do monthly or annually. Your brokerage account will show when the payment date is, so just keep an eye out. Once you start receiving dividends, you might want to consider setting up what's called a Dividend Reinvestment Plan, or DRIP for short. This automatically uses your dividends to purchase more shares of the same stock, which helps compound your investment over time. Most brokerages offer this option right in your account settings. One last thing to keep in mind. Dividends are taxable. Qualified dividends get taxed at lower capital gains rates, while non-qualified or ordinary dividends are taxed at your normal income rate. You might want to consider using tax-advantaged accounts, like IRAs, for your dividend stocks. At tax time, you'll receive a form called a 1099 div that shows all your dividend income for the year. That's it. Dividend investing can be a great way to generate passive income and build wealth over time. Start small, maybe reinvest those dividends, and watch your investment grow. Thanks so much for watching. If you found this helpful, please like and subscribe for more investment tips. See you next time.